Before I kind of dive into all the details, I typically like to look at this slide and sort of enjoy it and kind of count our blessing. This is a picture taken from Rancho San Antonio, one of the Vista Point, and it looks at our valley here, and we see here Mountain View, the Google area, and we just kind of, the way I look at it is here is Moffett Field, okay? And the way I look at it is always, you know, how lucky we are to live in such an incredible place from many levels, from the weather perspective, from economic perspective, and what a beautiful nature. With this kind of few words here, let's get started. So as far as our agenda, we're going to speak about 10 minutes about introductory stuff. We'll move on to address the key questions that everyone who is considering buying a home in Silicon Valley should be aware of. We'll talk about what you can afford and what are the best mortgages and so on. Obviously, as everyone is aware, with the inflation and mortgages and so on, definitely we see some movement that we have not seen for quite some time. We'll talk about the Silicon Valley economy and the real estate market, what drives our market today, and what are the key factors to watch for, what I consider to be as the leading indicators of what's going to happen in our real estate market. We'll talk about the importance of making sure that you partner with the right real estate team. That is a very key component in your success and sometimes failure in accomplishing your goals. And we will also obviously discuss how we can help you during this, I would call it a roller coaster process, particularly these days. With almost 2 hours of presentation, some of you might be scratching your head, okay, what should we do? And we would try to give you our recommendation, and we'll see where that goes. As far as the Q&A, we structured the presentation in a way that in segments, and so for the sake of consistency and coherence, we will stop at each segment and address any question that anyone might have. So if you want to ask question, you can raise your hand. You can also put it in the chat box and Q&A box and so on. And obviously we'll talk, okay, what's the next step? So with that, let's get started. So my name is Avi Urban. I'm a professional realtor, a full-time realtor from 2005. I've been doing real estate as a non-professional for many years before. In addition to myself, we have Ela Barak, who is on our team, who focuses entirely on Silicon Valley real estate, purchasing, selling, and investing. We have Nati Natman also with us today in our conversation here. And Nati, who is happened to be also a client and a partner, mostly focuses on investing in real estate outside of Silicon Valley. And even though this presentation is focused on Silicon Valley, if some of you might have questions, not too many, hopefully, we can address them. And also we would like to invite you to our introduction to real estate investing that will happen next month. Avi Urban, my son, he's doing commercial real estate, and he's acting as an advisor to our team for commercial real estate investing. As far as myself and my wife, we've been in Silicon Valley since 1985. We've been doing a lot of investment since we arrived. Actually, our first investment was like 4 months after we arrived in Silicon Valley. We bought a property with a partner back in San Jose for $170,000. This property is probably worth over $2 million today. We did not keep it. We sold it to fund my first startup. As far as myself, in terms of my professional career, I've been in high tech for over 20 years. Started if some of those companies are familiar to you, and also was a founder of Rsu, a high tech startup, and consider my real estate business to be my fourth startup, obviously not in high tech. We were blessed with, I would say, relative success in terms of our performance, business performance. And something which I'm very much proud of is the fact that we are also very much appreciated by our client. And as it comes to basically the fact that we have many recommendations on LinkedIn, Yelp, Zillow, and so on. Obviously, all of them are genuine recommendation. As far as our group goes, we are considering ourselves as a holistic realtors. And what we mean by that is that most realtors consider themselves as a transaction realtor, meaning they will help you buy and sell your property. In many cases, not all of them, of course, the relationship almost stopped there. We do not look at ourselves this way. We are looking at our client, our relationship with our client as a long-term relationship, which empowering our client in terms of many different levels, knowledge and insight to decision-making regarding real estate. We're helping our client buy and sell their Silicon Valley homes. We do help our client invest across the country. And the number today is closer to 350 in terms of homes and investment property that we help our client. And we also looking at ourselves as your long-term advisor regarding anything real estate, refinancing, remodeling, investing, and so on. Many of my clients are consistently calling us and asking for advice, and we're obviously happy to do so because this is how we believe we bring more value to our relationship. And as far as what we offer as a group, we do offer our monthly trend reports, which is basically what's happening in Silicon Valley real estate market. We do offer the Silicon Valley Home Buyer Masterclass, which you're basically attending right now. And this is something which we do every second month. We do, talking about, for too long though, on making a seller masterclass, which is still a work in progress. We have also the Introduction to Real Estate Investing Masterclass, which is every second month as well. As far as the schedule for all those webinars, it's on our website. As far as receiving our trend report, it's also on our website, and you are very welcome to register for one. Also, what we do provide is a free annual real estate portfolio evaluation and recommendation. Again, anyone who feels a need to I have questions regarding real estate, you are very welcome to ask us and consult with consultation, Zoom meeting, personal meeting, and so on. And also something which I'd like to remind everyone is our website is full of very valuable resources, information that might be of help to you. And as far as the webinar itself here, anyone who is interested might get access to our recorded session there. So with that in mind, let's get started into the presentation itself. So before buying your Silicon Valley home, what are the key questions that everyone who is considering buying a home in Silicon Valley should ask themselves? First of all, what I refer to as the strategic question, why to buy? Not everyone has to buy. It's not necessarily a must. It depends on your situation. So this is the question of what I call the strategic one regarding the question of whether you should buy or not buy a home in Silicon Valley. If this is the strategic question, the tactical questions are timing question. When to buy on one hand, what to buy, and how to buy. So all these four key subject or key question that everyone should ask themselves before they make the decision to buy these are the area that we're going to address also in our presentation. This presentation used to be a seminar, 4-hour seminar. Obviously, we'll not keep you for that long. We'll keep you, so it's a little bit of a dressed down presentation. And so what we will cover in each one of those areas is the following. So obviously the strategic question of why to buy, it's here have to serve your intangible needs. And obviously these needs can be served as a renter as well. You don't have to be an homeowner to serve those needs. And obviously the second, it has to be a good investment. Nobody wants to purchase a home in Silicon Valley, particularly in our prices here, unless it's some kind of a good investment at best, and at best not losing money on this purchase. As far as the timing question, we have the economy, which is obviously a key question here, and then the real estate market. So these two are the timing question. And obviously the what to buy depends on your personal needs and depends on your financial status. As far as you see the fact that one is gray and one is black, so we would, those grayed out are topics which we do not have time to address in this short version of the presentation. As far as the financial status, we're going to be joined by Arash Bauman for mortgage, guaranteed mortgage in about 45 minutes or so. And he will talk about the financial part of obtaining a mortgage and so on. As far as the home buying process, which is quite an elaborate one, again, we would not address in this presentation. And we will talk about the added value that the Urban Group is bringing to your buying experience. So these are the 4 areas that we're going to be addressing today in our presentation. So before you buy your Silicon Valley home, serve your intangible need. And let's see, what do I mean by that? So first of all, a home is the family anchor and stability and security. Obviously, you can relate to that. And I believe that most of you can relate, especially for these days after 2+ years, or actually 2 years of being with COVID and all the pandemic and all the implication of that. We definitely realize how important it is to have a home for your family and yourself, obviously, both for the need of housing, of course, and also of being in office for a very long time. All those kind of complex demands from your housing have definitely made some changes, some people's perspective about what they need and so on and so forth. So definitely something that you want to be aware of. The next one is the family bonds with your neighbor and so on. So we have seen that happening many times when our families, our kids are bonding with the environment, particularly schools. Our kids are, when they are going to school, they have friends from the same neighborhood and so on. So keeping those relationships is very important for our children and obviously their parents. Remodel your home for your comfort. Matter of fact, we see that we can basically buy a home which is not necessarily you're not necessarily going to buy your ideal home, but you can definitely turn it to an ideal home and make it a very, very nice place for yourself and your family. What we have seen, the chance of adding ADU and SB9, which is a new law basically that allows you to expand even further. Matter of fact, my wife and I literally just finished our ADU. We have relatively a large lot of about 9,600 square feet. And we used to have a very large front yard, almost 4,000 square feet. And what we did literally started about a year ago. And what we have done is we have basically added, an ADU, which we just completed it, and we just rented it out literally last week. We posted on Zillow last Thursday, a week ago, and we on Friday already have a party which was interested in And it was a very nice experience. We added about 830 square feet and we rented it for a very nice price. As far as other things, pride, comfort, and satisfaction of your own ownership, yes, it is. To me, I enjoy those kind of projects. I'm not sure that everyone does, but you clearly enjoy living in your own place and making it to your own liking. So that's definitely something which is being appreciated by many people who own their home. Predictable cost. And when we talk about cost, we're in the assumption that we have a fixed loan, insurance, maintenance, and so on. So we know that, yes, the loan is, if it's a fixed loan, it's fixed. Taxes in California, the Prop 13 can go up to about 2% per year. And insurance will go also with that, with inflation and so on. And obviously you have maintenance costs, which are mostly predictable. Obviously, I'm not sure how much you are aware what's happened to rent across the country. It is appreciated much faster than income across the country, as well as some areas in Silicon Valley. Obviously, we have seen during the pandemic that the prices were basically kind of dropped a bit, but we have seen since that obviously that has gone back and even crossed the values, some areas of what it used to be. A family can be evicted with 30 to 60 days notice. That is some dreaded phone call from your landlord. I've been in a situation where, at least 3 situations, where I got a call from some clients that, or people who became clients due to the fact that they received a short notice from the landlord. And you can probably imagine how difficult it may be when this kind of call arrives during your in the middle of the year, but not a fun situation. And of course, to some of us who loves animal, dogs are allowed. Many landlords don't like pets, but obviously as a homeowner, you can do. So if I missed anything, please send me an email or put it in the chat box, and I would be definitely more than happy to add something which I've missed. As far as the tangible benefit from home ownership, what we see here is that there is you can build equity. Okay, what is equity? Basically, equity is the portion of the value of the house that is belong to you, owned by you, versus the mortgage, which is obviously you owe to the bank. So OPM is the concept that other people money, and basically that's allows you to have leverage, and which basically helps you build your equity, in particular in Silicon Valley, as well as if there's a down market, can hurt you. So how does it work? So we have the compound return, which is equal to the future value of your home, is equal to the purchase price, plus the rate of appreciation, and the N is the number of years that you hold the property. So as long as R, which is the rate of appreciation, is positive, you compounding your return, and if it's negative, you have depreciation. And when you combine this rate of return with the leverage, and typically many people buy with 20 to 30% down, so you have a built-in leverage of between 3 to 4, which is a very substantial multiplier. And we're going to talk a little bit later on that kind of stuff. And you see how fast you can build equity, particularly in areas where there is a high appreciation, like Silicon Valley. Hedge against inflation, and there are 2 hedges against inflation, and particularly these days when we are basically on a daily basis are facing the inflation. The inflation in the United States been very low for the last 20 years almost. And we have seen, obviously, with all the circumstances post-COVID and so on, and we can talk more details about it if you're interested, but in general, we're seeing quite a substantial inflation this year. So the 2 hedges against inflation is, number 1, that your home value goes up with inflation, and number 2, since you do take a mortgage, and if it's a fixed rate mortgage, then the real money that you owe the bank every year is actually goes down. So you are protected as a homeowner against inflation in two ways. Okay, pay off principal, which is forced saving. Okay, obviously that is very important. Some people have issues or difficulties and having a discipline of saving money, and the temptation might be too high, but the fact that you do have to pay mortgage and taxes and insurance and you have to maintain the house does, in a sense, force you to save money, which hopefully is into your benefit. Added value. So when I talk about principal for saving, we talk about that. Added value. Okay, so for instance, again, when I talk about added value, the fact that homes price are composed of two parts: the land value and the construction in what's called improvement value. And when you adding ADU or do any expanding or any remodeling, okay, you are adding value to the money, to your home. And since when you're adding an ADU or you're adding an via SB9, what you actually already paid for the land, and nevertheless, though, the market value of a home is the combination of both. So, for instance, if we build an ADU, which cost us about $300,000, okay, but the fact that we now expanded our house by 800 square feet, okay, and the fact that in the area where we live, the cost of of square foot of home on the market is approximately $2,000, and we paid about $400 a square feet, we have an instant $1,600 a square feet gain on the value of our house. So this is one way of building more value into to your home. Okay, obviously you have to be careful not to overbuild and not to be the most expensive home in your neighborhood. And obviously you have to build it with good quality and with permit and so on. So you can basically, when you put it on the market for sale, that can be accounted for. A government incentive. As a homeowner, you have government incentive. And as is indicated here, I'm not a tax consultant. I'm telling you from our experience. In your particular case, you're going to have to talk to your tax advisor. So what are the benefits? You can deduct interest up to $750,000 a year, okay? And you can deduct SALT, state and local taxes, up to $10,000 a year. This part is less relevant to our area. This is a law that was passed by Trump. There was talk about the Biden administration reinstating the older law, which allows us to deduct it to a much higher levels, but it haven't happened yet. Also, tax benefit, you have capital gains taxes. Basically, when you sell your property, you have an exemption of $500,000 or $250,000, whether you are for a married person, a single person. You have the Prop 19, which allow you to capture your current tax base and transfer it through California. That is a big benefit for people who are thinking about downsizing and going to other areas and so on. We have the Super Tax Saver, which is a combination of the IRC 121 plus a 1031 exchange plus Prop 19. These are very substantial benefit. For instance, my wife and I were lucky. I wouldn't say it's smart, but lucky that when we bought our home for $400,000, maybe 25 years ago, and today it's probably worth close to $3.5 or $4 million. So obviously we have the exemption of the $500,000, but still we're going to be left with almost $3 million plus of capital gains. So by turning our property into a rental property for some time, we will be able, in theory, if we do that, to basically save the entire amount by combining the Prop 19, the IRC 121, 1031 exchange, and we can move to another area and can still capture our tax base. So substantial kind of benefits which are very unique to owning real estate. Use equity as source for kids' college, parents support, and so on. Obviously, this is something which you can continue doing. And actually, I do recommend it because for instance, let's assume our home is worth $3.5 million if it's fully paid for. So beside the appreciation that we're getting, that basically the money is captive and it's captured in this home, but we cannot use it. By taking a home equity line of credit or investing in and so on, you can basically improve your return on your investment as well. So these are very key information that if you probably may need some more clarification, but I will be happy to do that whenever you have questions. Let's look at the long-term perspective of real estate investing. What are the factors that are basically impacting the real estate market? So this is the Case-Shiller, the price home index developed by S&P Case-Shiller, and it give us kind of an indication of the fluctuation of home prices since the late 1980s. And let's look at what are the factors that are impacting that. So obviously the interest rate, because the majority of people who own real estate across the United States using a mortgage, we have seen that it was quite stable for a very long time. This is the period of 1980 when we had a very high inflation of 21% almost. Hopefully we will not get there this time, but nevertheless, we already have seen that our interest rate have jumped from, I would say, less than half a year ago to less than 3 to 4.2 and above. So obviously that has a substantial impact on your buying power. Population growth, which is basically the demand side, we see that the United States, as of the beginning of the year, have grown up to 332 million people. And we see that the population basically fluctuates on basically the US population is one of the few Western countries that have a positive population growth, which is a very important one for Social Security, for growth of an economy, and so on. And so roughly with 330 million people in the United States, there are 1 million people new people every year that need housing. And obviously that's an impact on the housing market and so on. As far as the cost of construction, what we see here, that the cost of construction is basically fluctuating also. And what we do see since the COVID-19, okay, we see a very sharp increase in the cost of construction, one which we have not seen for a very long time. Obviously, when the construction cost is going up by that much, obviously it has an impact on the cost of housing. And those who already bought homes are actually benefiting from this increase, even though that they already have paid for it and it's already completed. Nevertheless, though, it's like a tide that lifts all boats, and it lifts the boats which are the people who already bought those homes a while back. This is the long-term average inflation of about 3%, you see. And what we see here, that this is the financial crisis of 2007. And what the impact that we see now is how does it impact the different places? So what we see that as of the end of last year, home price of the US median house price was about $346,000. So we have seen the increase in housing market, not only in Silica Valley, but we have seen it across the country. And that increase is about almost 17%, as you can tell. When, as I indicated earlier, there is the cost of construction and the land cost. And what we see here, that basically outside Silicon Valley, the cost of land is only about 20% of the cost of construction. So as a better hedge of inflation, the larger the component of construction, you have a better hedge of inflation. If we look at Silicon Valley, again, as of the end of last year, Silicon Valley median prices went almost by 12% up, but the land component is much higher than we have across the country. And so we do see that if you are thinking about real estate as an investment, as a hedge, then obviously where you have a larger construction cost, you have a better hedge against inflation than in Silicon Valley. Nevertheless, it doesn't mean that the Silicon Valley land cost is not attached to inflation, but is attached to how well this area is doing economically. And that is impacted by the economy, local economy versus global inflation, which is impacting by basically oil and lumber and copper and all those minerals that basically have a global supply and demand factor to that. What happened after, obviously, Q3 of 07 was the time when the market collapsed after the financial bubble. And if we look at what happened since, okay, so this was the financial bubble, okay, housing bubble of 2007. So where are we today compared to those days? So we clearly see that we have passed way, way over what it was, the financial bubble of 2007. So look at where we are there, roughly 220, and now we're at 340. And it's not unique to Silicon Valley. Let's look at other places, and you see that it actually happened across the country. We see it in San Francisco, condominium. We see it in Los Angeles. Again, home prices, Los Angeles. We're seeing it here with, you see that across San Diego. We see it in Seattle. We see it across the United States. Everywhere we see that, okay? And that's something which we have to take into account, that it's not only in the United States phenomena, okay? It's happening many, many places, okay? So that's something which, just a second here, I have to add here our lender to our presentation, okay? This is Portland, okay? So it's not a unique, as I mentioned, phenomena to Silicon Valley. It's across the United States. Dallas, Texas, Phoenix, Arizona. And by the way, I just read an article today that Phoenix, Arizona is the place where the inflation is the highest. Phoenix, Arizona was hurt very, very badly in the financial crisis. There was an incredible overbuilding there. But as you can see, it's already past those highs of 2007. Boston. So basically, we see that all over. New York is a little bit slower than others. But again, also we see a substantial increase in prices over there. So there is the classical question of, are we in a bubble? Okay, this is a question that are always being asked. Is real estate in a bubble? Is Silicon real estate in a bubble or not? Before I answer these questions, and this question is not unique for today. This is an article from 2013, okay? And this is, if you look at that, and what we see here, this is the 2009. Here, the home prices here are the 2009 prices. These are the 2007, March 2007. This is where the bubble burst. Okay, this is the 2007 when the home prices were about 738, and after the crash, it went down to 295. And those numbers, by the way, is misleading, because I will talk to you about later, few minutes, why it is misleading. But anyway, what we're seeing here, that was 2007 and that was 2013. So we saw from the crash it going up, and obviously where we are today. I'm sure that everyone on this conference call would be more than happy to buy in 2007 prices today, but obviously that's not the case. So what is a bubble? Before we answer the question of are we in a bubble or not, let's ask the question, what is a bubble? And a bubble is not only, this definition is not only true for real estate, it's true for any asset, okay? It's asset prices, surge in asset prices, but its role, as we talked about, significantly above the fundamental value, okay? And demand decreases or stagnates while supply increases. Sharp drop in price. So this is definition of what is a bubble. But here is the rub. Bubbles are often hard to detect because disagreement over the fundamental value of an asset and how to measure its fair market value. So yeah, these are very nice words, but okay, how in the world do we measure what is the fair market value of an asset? The best definition that I know is the market definition, which says whatever the market is willing to pay. So this is the one issue that we have to, when we're dealing with this question, if we're in a bubble or not. Obviously, that question is on the mind of many people, including Robert Shiller, as I mentioned, is beside the S&P 500 K-Shiller index. And he basically tried to characterize this question by the following parameters. Sharp increase. Yes, we see sharp increase across the Silicon Valley and across the United States. Yes, that is very true. Great public excitement. I see some, nothing compared to the 2001, 2007. So there is talk about it, but I would not call it as an excitement. Accompanying media frenzy, again, I would call it, there is a coverage, but there is no frenzy of kind of as compared to what it was back in 2007 and before. Stories of people earning a lot of money, and there are some stories, I'm sure about it. As for growing interest, I don't believe that there is a growing interest. There is people basically, in particular with these kind of prices, is an interest of housing, and some of those are basically also preserving their capital. A new area of theories, I don't see that. Okay, I don't see new area theories like we've seen in the past. And declining in lending standard, absolutely not. I don't see that actually. And anyone who went through a mortgage process in the last few weeks or months can attest to that. So how to spot another definition, how to spot the next bubble. Okay, also that's by Freddie Mac, using the price to income, basically affordability a ratio to spot market out of bonds. So it's very important to watch actually what are the kind of median prices of homes compared to the median income. It's a very, very important factor. And then, are there any financial reason for the high ratios? Okay, is there a rapid growth in a geographically specific industry? And that is a key question here for Silicon Valley. We know that our area lives and dies by the high-tech industry. So clearly, we have this phenomena here of very dependent on an industry, which is it's an industry which is growing very fast and becoming much, much more critical in our economy. Are the credit conditions deteriorating? Absolutely not. We don't see that. And Arash Bauman from Guaranteed Mortgage will be able to talk about it in a few slides. Is the leverage increasing? The leverage is not increasing because there are some ratios that the banks are following very critical. It has to be roughly below 43% debt to income ratio. Banks are very strict. If you want to buy a home above those ratios, you're going to have to put more down payment. Again, Arash will be talking about it. Evidence against US bubble, a lack of inventory, and that is very important. We have a huge shortage of inventory across the United States. We have on one hand a population growth, which we mentioned as approximately 1 million people a year. On the other hand, we have seen a major drop in supply since the financial crisis of 2007. House flipping. We do see some house flipping. I would say a little bit more in the last year or so, more than we've seen in the last years before. And that's mostly because we have seen a very high appreciation, lack of inventory, and people who have quite a lot of money actually as well. More cash buyers. If you look at the California numbers, we have a significant people with cash buyers in Silicon Valley. A lot of that comes from people who are diversifying some of their stock portfolio into real estate asset and want to be a little bit more diversified. So, in other words, I do believe that Silicon Valley is not in a bubble. Okay, but again, another key point to demonstrate that a lot of things that look like a bubble are not. And making calls about a bubble is a very risky business, okay? The problem of might be when investing in a vehicle fueled by surge in borrowing leverage is a killer. We don't see that, as we mentioned that. This pattern of different is different than we've seen before. And if we look at this at the chart below, what we see here is that if we look at the household financial obligation, so obviously those points are where the household financial obligations are very high. So look what happened during the dot-com crash here. Sorry, here's the financial. This is the dot-com crash of 2001, roughly, where we see a relatively high financial obligation by U.S. household. We see the financial crisis of housing crisis mostly, which again put us into a recession. And here's where we are today. So in terms of how's the financial obligation, we see that actually quite below long-term averages, and that is a very important factor to remember as whether talking about whether we're in a bubble or not. There is a sign or indication of excess, but haven't led down to pass of unsustainable bubble or credit yet, and there is no evidence overbuilding in the housing. So in other words, I do believe that in general there's no bubble, and when we're going to talk specifically about Silicon Valley and our economy, you're going to see that we have a very unique place here that is we are benefiting from it, from the industry that is keep laying golden eggs to many people, not to everyone, and we are benefit from that. Okay, so let's look at the long-term view of real estate market. Blue is California, red is the United States. So this is a chart from the last from 68, 53 years of median price increase. Incredible chart, okay, unbelievable. Obviously, this was the economic, we had a adjustment in California. This is the post, that was during the Reagan years of base closure in California and so on, which led to a recession in California. This is the financial crisis, where we've seen a dramatic drop, which lasted for a relatively short period of 2 years, okay? And then we have seen a huge increase ever since. Ever since, we have seen consecutively years of appreciation, okay? And we look at the California, Silicon Valley in California in particular, has went out of this crisis in the summer of 2010, while the United States still was in a crisis. It recovered from the financial crisis only in late or beginning of 2013. So if we look at long-term averages, we see that the US has an average of 5.6% appreciation per year, while California is about 7.5%. If you put on top of that the fact of 80% of people are using leverage, and you see, you can imagine over whether it's 3 or 4 or 5, you immediately can understand what kind of returns you may get if you own real estate in California or in the United States as well. If we just compare to the stock market, the long-term average since 21 is about 8.12%. So I want to plant that question in your mind. Knowing that the S&P 500 actually went very substantially over even California real estate market, if you had money, let's say 20 years ago, where would you put it? In the S&P 500 or in buying Silicon Valley or California or US real estate? We'll talk a little bit more about it later. So actually, so here is the chart that I wanted to talk to you. So basically, my wife and I arrived to Silicon Valley in 1985. Back then, the areas of Cupertino, Sunnyvale, Mountain View, Palo Alto, I kind of composed an artificial index of the median home prices in this area. So back in 85, the median home price was $230,000. When I compare that to the end of last year, it was about $3 million. So it went up almost over 13 times. A typical mortgage went from $184 to a whopping $2.5 million almost, quite an amazing number. Household income went up only by 5 times. So just by sheer saving, we would not be able to catch the difference. In terms of job stability, when I arrived, there was pension, there were all those kind of good stuff or bad stuff, depends how you want to look at it. And today people are moving often from one place to the other, which basically give us a challenge. And also particularly when you talk about retirement, when people retire at age 65, will probably have 15 years. Today, they live about 25 years over that, which basically raised the question, where this money going to come from, and so on. And if we look at the S&P 500, back in the 85, which was 211, compared to the end of last year at 46, so we saw that the S&P went 22.6 times compared to 13. So I'm going back to the trick question. If when my wife and I arrived to Silicon Valley back in 1985, and all we had is 20%, $46,000 to invest. Should have we bought a home, or should we put our money in the stock market? And I'm going to go now through the math with you to make sure that we're all on the same page. So let's say 1985, 20% down is $46,000. Silicon Valley gains between this number and this number, $2,839,000. Okay, so if I would have, so the ratio between the gain compared to what down payment I had, I made almost 61.7 times my money. Okay, so I made 61.7 times my money compared to the 22 on the stock market. So what are the assumptions here? Assumption here, I'm using leverage here to buy a home, and I'm not using leverage on buying the stock. Majority of retail people who invest in the market do not use leverage or margins and so on, while the majority of people who buy homes use leverage, okay? If we look at the S&P 500 gains, it gained 22 times, so it's $1 million. And I've gained almost 2.7 times, almost 2.7 times more investing in buying a home in Silicon Valley versus putting in the stock market. And yes, of course, you had to pay interest and taxes and maintenance and so on. And of course, those who put their money in the S&P still had to pay rent. On top of that, we talked about the benefit of ownership, the IRC 121, the exchange and so on, which are not available to you when you are investing in the stock market, unless you are investing in an IRA. And even then, when you invest in the IRA, obviously when you're going to have to pay it off when you take the money out, and which is definitely overall, I believe that the real estate in general, whether Silicon Valley or outside, is an asset class that everyone should consider. So obviously it begs the question of owning versus renting. So let's pick a number of 1.6, which is becoming more and more rare in Silicon Valley. I'm going to have to update my chart for the next presentation, probably more in the 1.8 or so on. But let's look at those numbers. With 20% down, it's about $320,000 down payment. Loan amount of $1,280,000. Interest rate roughly is about 4%. As of my last conversation with Arash earlier this week, so it's roughly about 4%, meaning that your interest payment, a monthly interest payment, is about almost $4,300. You have principal, which is in green, because this is the first forced saving every month. You are basically saving or reducing your equity, your loan obligation by $1,844. Taxes about $1,667 a month. Insurance is about $100 a month. I'm assuming maintenance, I'm allocating maintenance costs to the house, $240 a month. Your total cost is about $8,100 a month. Renting such a home, maybe it's a 3-bedroom, 2-bath in Santa Clara or something, may cost you $3,750 roughly. And what we're seeing here that basically, if we look at home prices in Silicon Valley. This is average multifamily. This is basically what you're seeing here. This is a rental home for rental from 22 for studio to 3,600 for 3-bedroom. So I put about 3,750, and what we see, and we've seen some reversing trends of rental actually going up recently. So this is the rent, how much rent you will cost. So total cost, annual cost of home ownership is about $9,700. If you're in a tax bracket of about 32%, you're actually paying $84,000 out of pocket. Appreciation is 4%. 4% and I'm sure it's very conservative. This kind of appreciation. If you look at the average 10-year average appreciation in Sunnyvale for single-family home is about 10%. In Palo Alto is about 10.7, and we see condominium townhome is different. So I put a 4% here, very conservative. I didn't want to make the numbers even more better. So I want to be conservative, because I hope that the kind of appreciation we see now in Silicon Valley is incredible, and I hope that the long-term appreciation is going to be more in the 4 to 6% rather than in the 10% and so on. So total rent price is about $45,000. If we do own versus rent, so we are basically owning a home in Silicon Valley under these assumptions. About $40,000 more out of pocket for you every year. But if we take into account the fact that you are reducing your mortgage, building your equity, having appreciation, conservative appreciation, you're going to be still better off by about $46,000 a year, every year, by owning a home under those assumptions. So obviously, what I want to make sure that you understand, this is for demonstration purposes only. Obviously, you're going to have to speak to your accountant regarding those exact numbers. One more thing that I want to start building equity. It's very obvious that when we look at how fast build equity and we compare net worth between renters and homeowners, what we see that isn't without counting on the value of the home. Basically, what it kind of implies that as a homeowner, you're much more conservative and careful with your finances. And that's what actually happens. So between your early 20s to late 20s, you're better off by 29%. And when you reach over 36, you're better off by 57% compared to renters. Another study that shows homeowners are far wealthier than renters. Housing is an investment vehicle, and we see that. So between the ages of 50 to 64, this is the home equity and the non-housing wealth. Okay, so we see the difference between home ownership, renters, homeowners and renters. Substantial difference between the wealth building of people who own home. This is the component of the home equity. And another study, again, shows the same thing. So basically, study after study shows that not only that you're building your wealth through your home appreciation, home equity, but also through the discipline of home ownership also helps you become a better saver, building your financial security to the future. Building wealth. So what we see, Americans' top choice for long-term retirement investment, we see housing, real estate as the prevailing vehicle, financial vehicle for building equity. Okay? With that, I'm going to pass it to Arash. Arash, can you talk? Arash?
Yes, I'm here, Avi. Can you hear me?
Okay. Yes, Arash from Guaranteed Mortgage will be discussing what can I afford, or how to get a mortgage, what to watch for, how to prepare for it, and how not to make mistakes. Arash, please go forward.
Good afternoon, everyone, and happy Sunday. Thank you, Avi and the Urban team. So just a quick background about myself. I have been with Guarantee Rate Affinity for a year approximately. Prior to that, I was with 20 years with Bank of America. I was a direct lender. At Guarantee Rate, we are a correspondent lender. The loans, they all get underwritten in-house. However, we can submit the loan to any of the banks, whether it be a VA, Wells Fargo, Chase, Citi, JP Morgan, all of them. So we basically do all kinds of paper. We do from A paper to no document loans, no income verification, and all of those, which are back now. So that's a good thing, of course, at different rates and all of that. As far as where the market stands, as far as mortgage, we know already, it's been announced, and 2 weeks ago, Federal Reserve increased the prime rate, which is the Fed funds, by 0.25%. They said that this year they're going to increase interest rate by at least 6 more times, up to 6 more times. So we're going to be looking at an increasing interest rate market. It does affect the payment and qualification. So if any of you have been approved for a mortgage a year ago or 6 months ago, you'll want to revisit that because interest rates are going up and they're higher at this point. As far as what we look at to approve you, all lenders, regardless of what bank you apply, we look at 3 parameters to approve a client. I'm going to list them one by one, and each parameter is 33% of your qualification, and you have to hit all 3 of them. The first one is credit and depth of credit. Under credit, there is 2 criteria. There's credit score. Credit score determines interest rate. Also, each segment loan, whether you're looking at the conforming loan, which is less than 647,000, or high balance, which is between 647 to 950-ish, and jumbo or non-conforming, which is over 950, requires certain credit score. Under credit, now you can have a great score, but you also have the depth of credit. Each applicant is required to have 2 years of credit history in the US, and you need to have 3 trade lines by standard in your credit that they're open for 12 months and without any derogatory or any type of missing payments or anything like that, disputes or things like that. So a lot of people not a lot of people, but when I talk to my clients, sometimes they think they have great credit, but when you look at their credit, there is no credit card. So that's kind of a problem. So you always want to have established credit by applying credit cards. So that's the credit piece. The second aspect is your down payment, is your assets and collateral. For whatever program that you're applying to purchase a home, you need to have the minimum down payment required. For instance, if you're buying a property for $3 million, right now it requires majority of lender, they can do that. They need at least 20% down. I can do up to 10% down, up to 3 million, but of course it's at a higher rate and all of that. But you need to show that you have the down payment plus reserve. How much reserve do you need? It depends on the loan amount. The bigger the loan amount, the more the reserve is required. For instance, if your loan is less than $1 million, you need 6 months of your payment in reserve. What is the payment? Is principal, interest, property tax, and insurance. If the loan is between $1 million to $2 million, you need 1 year of your payment in reserve, 12 months. And as the loan gets bigger, you need more and more reserve. If you apply for interest-only loan, you need even more reserve. For reserve, we use your checking, saving, and CD account at 100%. 401k retirement account, they give you credit for 60% to $1. And then stock account, if it's not liquidated, you get credit 70%. So that's for reserve. The collateral itself, the house that you're buying, has to have no health and safety issue. Any lender, any bank that you're doing your loan with, when you go into contract, they send a local appraiser to the property. Appraiser is not a general contractor. They're not going to go under the house and take a picture from, the foundation and all that. However, they take a visual inspection of the house. They take picture. And if they see any type of health and safety issue, you have to fix that before you can close escrow. Like if you're a handy person, you can't say, I'm going to fix it myself. It has to be done before. The type of issues that I've seen in the past that it's like causes problem is like visual termite and mold, broken door, windows, missing appliances, electrical exposed wire, electrical problems, not working kitchen, not working bathroom. The appraiser check, make sure there is electricity in the house, make sure the toilets flushes, that the water goes down the drain and all of that. So one aspect was credit, one was assets and collateral. And the last thing is your buying power. Banks use a formula that's called debt to income ratio. Basically, the formula is that the combined monthly debt divided by your gross monthly income has to be less than whether 43% for rental properties, 45% for majority loan, and some banks and investors on exception, they go to 50%. So that's your combined monthly debt, which includes the proposed housing payment with tax and insurance, divided by your gross monthly income. Now, as far as income, the way we calculate income, it depends. So if you work for a company, for your base income is used as your last pay stub. Right now, I'm talking to a client. She needs to use a higher income. She's getting a raise in 2 months. That income doesn't count. Even if you have the contract, you need to have the first pay stub reflecting that raise. For bonus income, you need to have 2 years of history. They average your bonus. If your bonus between 2020 and 2021 was inclining, they average. If your bonus came down, they use lower of. If you got 100,000 bonus in 2020 and you got 5,000 in 2021, you get no credit for bonus. They don't average that. They don't give you lower of. It's too much of a fluctuation. RSU, we have a lot of clients around Silicon Valley with RSU income. Yes, we can use RSU income as long as you have 3 years of vesting and grant schedule. The company has to be public and you don't get credit dollar to dollar. Roughly, there is a calculator. Each investor use their own method of calculating your RSU income. Generally speaking, you get credit between 25 to 40% to dollar. So if you get $100,000 in Google RSU, you're not going to get credit for $100,000 income. You get credit probably for $30,000. So that's how we use income. If you're self-employed, you need to have 2 years of self-employment income based on your tax return. All the deduction that you list minus depreciation or office use of home is subtracted from income. You get credited back to depreciation and office use of home because it's a paper loss, it's a passive loss. So you don't get hit for that. So if you're going into a contract to purchase a house, you don't want to change job if you're counting on your bonus to qualify, because bonus requires, or RSU, 2 years of history from the same employer. If you work for Apple and you're getting RSU and just transferred to Google, you most probably, it's gonna be in a gray area, but most probably you don't get credit for the bonus or RSU. You just get credit for the base income. However, they look at that on a special cases. It depends to the rest of the package. When your file falls into a gray area, underwriters that they're underwriting the file manually, they look at compensating factor. Number one compensating factor when you apply for a mortgage is your reserve after close. How much money do you have left after paying the down payment and closing costs? That's number one compensating factor. Also, residual income is very important. If your debt to income is 45%, but you make $1 million a year, you're at a lot lower risk that if your debt to income is 45,000 a year and you make 100,000, because your residual income is substantially less. So there are a lot of things. Your credit score determines your credit history, how many late payments you had. If you're a first-time buyer, your rent is very important. All lenders, regardless, they do a written verification of rent with your landlord. They want to see the last 12 months you have paid your rent on time. So these are basically the basic criteria we look at to pre-approve you. And every lender, whatever application you always complete, they're gonna ask and they're gonna fill out information to get basically to these three parameters to get you pre-approved. That's about it. If anyone has a question, I'm here to answer your question.
Yeah, Arash will answer question in the session of the Q&A. If there is one takeaway from what Arash just described, is going back to the lending criteria compared to the .com and financial crisis. So banks are very very careful with who they lend money. They have very strict requirements, and we do not see the over leveraging, the what's called the ninja loans, no income, no job loans, no that we probably have seen in the past. I'm not sure if any one of you saw the movie The Big Short, where people were buying left and right and kind of cheating on their income statement and so on. So anyway, the world is very different compared to those days. So just to look at a little bit, what does it take to buy a home in Silicon Valley? So if we look at the Sunnyvale median price as of December of last year, to buy the median price in Sunnyvale of $2.1 million with today's rate of about 4%, you need to have a household income of about $283,000. In Palo Alto, you need 512. In Santa Clara, 283. In San Jose, 219, and in Menlo Park, 452. So obviously, the more down payment you have, the less you'll be able to reduce the household income. But nevertheless, under those circumstances, this is what we are seeing today in Silicon Valley. So before buying your Silicon Valley home, Arash, thank you very much. Stay for the Q&A. Probably in a few slides, we're going to do the Q&A here. Okay, so on the 30-year, the drawbacks, obviously there are drawbacks of home ownership. On a 30-year fixed loan with 20% down, your outflow is higher than renting. We saw that for about almost $40,000 a year on the example we use it for $1.6 million home. Cost of loss opportunity on the down payment. If you are a professional investor or very successful in the market, by putting the kind of down payment you need today, and you may lose the opportunity of making more money on the stock market. The risk of declining value, that's obviously is a possibility. We have not seen that for quite some time, but it is a possibility. Illiquid asset and the cost of transaction, buy and sell, obviously it's not cheap. To buy a home, there is an associated cost. And to sell a home, associated costs, and something that you have to take into account. Loss of due to fire, earthquake, and so on. We've seen that happening across the United States as well as in the Valley and in California, particularly fire that we've seen in the last few years that devastated the entire communities. The obligation, which is a serious one, by keep you at night, obviously, and there is another the downside, basically, if you don't get along with your neighbor, you basically don't have much of a choice unless you want to move away. So these are what I believe are the drawbacks of home ownership. There's obviously a lot of advantages. Nevertheless, though, we should not forget that there are those issues as well. With that, I would like to open it for a Q&A. If you have any question, please raise your hand, type in the Q&A or in the chat box, and we will be happy to answer. We will take about 3 questions and so on, so because we want to keep the time here and move on. So any question, are there any question? Let me look at that. Please raise your hand if you have any question. Is it being recorded? Yes, it's being recorded. People participating in the webinar are going to get a link after we do some cleanup, probably Wednesday or Thursday this week. Any questions? Okay, I don't see any question. I don't see any raised hand. So any question? Okay, I see a question here. Are rates going to be 8% to fight inflation? Arash, can you answer this question from Dan?
I don't think 8%, not probably this year. And I think I'll see it next to maybe 6%-ish. But yeah, it is going up really quickly. So,
Okay.
and even though the rates were taken up on not previous Wednesday, the one before, it was already adjusted for lender. Lenders had already increased. Like that day that the rates went up, it didn't really change. So lenders are already putting all that in their pricing. So
Yeah.
I do see the rates a lot higher than what we have right now.
There was a question about what's the current rate. So roughly, we showed it in the slides that with good credit, 20% down, and good debt to income ratio is about 4%. Correct, Arash?
That's correct. That's a 30-year fix. You can go to like low threes with arms, 5-1, 7-1, 10-1 arm. But yeah, 30-year fix is around 4%.
There is a question from Danny here. Will it affect house prices? I believe it will. Depends where, depends how much. And I actually will show you a chart a little bit later that demonstrate this impact, and which happened in Q4 of 2018. Okay. Okay. Any other question? I see here on the chat here another question, and that will be the last question before we move on. What current interest rate is about 4% for a 30-year fix. If you want, if you get a 10-year arm or 5-year arm, the rates are lower. So with that basically in mind, we're gonna continue in our presentation and go to the next segment. Okay, what is Silicon Valley? So the Silicon Valley economy. The Silicon Valley economy, in my opinion, is a very, very, very critical element, obviously, of the Silicon Valley real estate market. But so let's dig into this subject. So first of all, what is Silicon Valley? Silicon Valley is 5 counties. Okay, we have 4 employment hubs. We have 3 economies. We have the established innovation industry, the big names that we're seeing. We have the startup innovation industry. Those are the future of our industry. And obviously we have other support industry from government, healthcare, and so on. So this is basically what is Silicon Valley in terms of geography and so on. If we look at the geography, and this is basically this is from joint venture Silicon Valley, and it looks this is an incredible source of information about what's going on in the valley. I would strongly recommend any one of you interested to follow that. So in terms of area, we see that area population is 3.7 million. We have 1.6 million job. We have an annual average earning of 170 almost. If the US average is about 65 or something like that. We have net foreign immigration of about 3,000, and we have a whopping net domestic migration of almost 38,000 people. If we compare it to the previous year, 21, okay? So look at the previous year. Obviously the area didn't change. Population dropped by almost 300,000 people. Jobs, we see very interesting. Jobs, number of jobs went up almost by 100,000 people. Pay went up by almost, $17,000. And look at the net foreign immigration, okay? So that is some of the residue, obviously, of 2 things. The pandemic, number 1, and number 2, also the Trump administration of giving very hard time with H-1B visa, particularly if you think about Silicon Valley, 69% of Silicon Valley engineers are foreign born, 69%. And obviously, immigration of those highly qualified young professionals is very, very important to the future of Silicon Valley. And we look, even then in 21, we saw that we have over 30,000 people leave Silicon Valley. We're going to look a little bit more about that information later, who is coming, who is going. And you're going to see a very interesting stat about the mix of that population. So what is the 22 highlight? Employment is back pre-pandemic level. though more constrained in high tech, which basically says that a lot of other industries, whether hospitalization, restaurant, support, and so on, have not recovered, but the tech sector have recovered very, very well. Silicon Valley engine is red hot, which is very important to us, obviously. Commercial development continues to break neck, which basically means that those big companies in Silicon Valley believes that there is a lot of future in employment here. We hear a lot of talk about people moving to Austin, Seattle, Los Angeles, and so on. But the fact is that the big companies still have a very strong belief in this area, and it comes to basically to fruition by the fact that they are investing heavily in commercial real estate. Of course, it doesn't exclude other area of expanding as well. So the risk exists only if the quote unquote the industry cake will stay the same or shrink. If the industry will grow, it can grow in many different areas, including Silicon Valley, and it's still going to be a very important factor in our growth locally. Regional population is declining, but we're going to see a little bit later which population is declining. But it's also a problem because you cannot have a healthy community if we don't have doctors, nurses, restaurant people, grocery people, policemen, fire people, and so on. So having a population only for high tech would not work. We need to have correct some problems that are very serious problems here in California in general and also in Silicon Valley. Income are growing despite inflation. Okay, that's very important. Home sale price continue to soar while average rents edge downward. Homeless amounts. We do see actually that is a trend that this is a stat for 20. It's published in 22, but it actually looks to 21. We do see a reverse in the trends here. School kids are getting back to track. There's less traffic. Also good news, bad news, but that's what's happening. Viewed through the equity lens, Silicon Valley has miles to go. Basically, what it said, there's a lot of inequity in this area. A lot of people will make a lot of money, and there are a lot of people who make not enough money. So as Silicon Valley economy prosperity declines as a function of our local innovation-based economy, period. If you guys want to see what's the future of the real estate market, watch those leading indicators that I want to bring up to your attention here. Leading indicator is the ETF, basically, which tracks the stock market of mostly high-tech companies. And if we want to look at the future leading indicator for future industry, the IPOs, VC and angel funding, and merger and acquisition. These are the two leading indicators that will tell you what is the near future of Silicon Valley look like 3 to 5 years down the road. If we look at those numbers, these are also not yet updated number for the 21 years. So we see an incredible industry that 20% companies of the 150 largest company are having an enormous amount of sales. The 20 company have about 940 billion, and the 150 about 1.12, almost 1.1 trillion. Okay, we see sales growth, number of employees, revenue, and so on. So it's a tremendous industry. I'm sure some of you have looked at those chart about California being the sixth. If California would be an independent country, it would be the 6th largest economy. If Silicon Valley would be an independent country, it would be the 15th largest economy in the world. Very substantial industry here, which has a major impact on our area. And if we compare the GDP of Silicon Valley to the United States and California, we clearly see that our contribution to the United States compared to our population is unbelievable and is very, very much significant. If we look at those leading indicator, and this is a chart for since 2019, when I'm tracking SPY, which is basically the general market compared to the high tech industry. And to be fair, the SPY is about 20% of high tech companies. So in a sense, the high tech companies also lifting the SPY, the S&P 500. But nevertheless, though, what we see is that the high tech market, if we look at the gap between the performance of the technology company. This is just January 20, just before we went into the pandemic. So you see the SP 500 compared to the AGM, and we see there is definitely more higher appreciation in the high-tech industry. But if we look here, currently, as of March 2024, we see the performance of the high-tech sector substantially outperforming the other rest of the industry of the United States in general. So very much what I consider to be the leading indicator that tells me basically a derivative of those companies' performance will be impacting the Silicon Valley real estate market. And if we look at how big tech got even bigger, so look at the incredible value of those companies, okay? So market value of the 5 biggest US tech stock, okay? This is back in 2013, 1.1 trillion. Apple alone is worth today about $3 trillion. So if you look at the wealth of Silicon Valley, we went from 1.1 to 7.5 trillion. That is as of February of last year, okay? Incredible amount of appreciation of value in this valley. So in most every facet of life, that is very important. The tools we use work, study, play, shop, and interact. The way companies operate and market their product, people and businesses have become more reliant on technology. Okay, this is a very, very true. If we have seen anything happening in the last 2 years, how the entire world is reliant on technology everywhere. Every part of our life has technology component. And obviously, as people who work in Silicon Valley, we are benefiting from that's a need of our industry. Amid one of the most astonishing economic records, okay, we talked about that. So there are obviously issues with those companies becoming so dominant and so on. But nevertheless, though, we are blessed to live and be associated with those kind of industry. As far as the innovation industry, okay, we see there funded startup. We still see a very, very healthy industry. If we look at Silicon Valley, being Silicon Valley Peninsula in San Francisco, we see a substantial investment locally. We see a lot of investment actually taking place in San Francisco as well. And in California, as we see, we are definitely the lion's share of that investment. As far as venture capital investment, look at the kind of numbers, Silicon Valley, US, and so on. Again, Silicon Valley is a dominant, attracting the majority of the capital. If you look at California, about 70% in California, and we're looking at is a substantial amount of money invested locally in Silicon Valley. We look at the angel investment, okay, angel investment, Silicon Valley, San Francisco, rest of California, rest of the United States. So basically, Silicon Valley and San Francisco, this is the angel investment part. We see that other part of California are getting more of the angel money compared to other years in the past. As far as mega deals, okay, Silicon Valley, San Francisco, we see here a substantial amount of investing or M&A and mega deals happening in Silicon Valley. Still very healthy. The rest of the United States is happening as well, but nevertheless, though, we are very much a big percentage of this industry. Number of IPO pricing, okay, Silicon Valley and San Francisco, we see that there's basically the liquidation event that allows those people who work those companies to take some of that money and buy real estate and other things that they wish to do. So these are the leading indicators that we are following. A number of deals, share in California deals. So overall, we see a very healthy established industry. We see a very promising startup industry and future investment. So that basically leaves me with relatively optimistic point of view on the future, near-term future of Silicon Valley. Nevertheless, though, there were always people who basically were basically stop believing in the Silicon Valley. And this is something which we have seen over the years. Back in when my wife and I are in 1985, and this is a very famous statement by Larry Ellison post bug 2000 and the dot-com crisis. We have seen a lot of growth since, no question about it. And that's also a very important thing is that to remember that successful places tend to stay successful, okay? They basically have the resources, the critical mass to stay successful in the future as well. As successful places tend to reinvent themselves, there's no question about that. There is the ecosystem which allows all the capital and talents be available. But nevertheless, I always ask myself the question, the Detroit question. Detroit used to be the center of innovation for car and technology for many, many years. Unfortunately, they fall asleep and they let the other industries, other countries actually, and companies basically take it over and they fell asleep on the switch. It can happen to Silicon Valley as well if we're going to stop innovating and going to basically rest on our success laurels. It might happen to us as well. Another risk that I see to Silicon Valley, which I refer to it to be a victim of our own success, is if Silicon Valley becomes such an expensive place that young professional and other support industry cannot live anymore in this area, and also regulation issues and so on, we may become a victim of our own success. And I hope and would like to believe that a lot of the industry and politicians are aware of that risk and should not rest on their laurels and think that that can continue forever without addressing those critical issues. I'd like to open it again to Q&A. Let's see if there's any questions here. So if you have any questions, please let me know. I see there is one in the chat. In case you have a question or okay, this is Arash basically put his number. Do we have any questions before we go to the next segment? Please type your question, raise your hand, and we will be happy to answer any question you may have. Last segment was about the Silicon Valley economy. And I'm sure everyone is aware of people moving to Austin, Texas and other places and so on. As I mentioned, and I show you some statistics a little bit later on who's moving and so on, but that's not a new phenomena that California was experiencing loss of population for years. It's true that in the last few years, we have seen mostly a negative migration taking place in California. So if I don't see any questions, I will move forward to the next segment. Okay. Okay, the Silicon Valley real estate market, prices and trends. Okay, so what we see here, this is the 22 years of price performance of Silicon Valley real estate. What we see here is the blue is this is the median price versus the average price. And the reason we have such a big delta between the average and median is because we have on one hand homes that are priced at $10–20 million, and we have a home that are priced below $1 million. So obviously we have this kind of discrepancy. And this is the financial crisis. And look at the price drop that happened here during 2007 to 2010. And that's very important to watch what is being measured here. And you say we're measuring the average, okay? So when you're measuring the average, you have to also take into consideration the mix of homes that are being sold, okay? So what we see here that the number of homes over $1 million was about 30% of the market when that market dropped in August 2008 to about 18, while this number jumped by a factor of 5. So obviously that's a mixture which impact the average. Nevertheless, though, what it actually say from an economic perspective is the people who lived in the lower demographic neighborhoods, if they lost their jobs, they couldn't continue making the payment, they had to put the house on the market. And when you flood the market with homes, obviously prices are dropping more substantially. Okay. Another thing to remember, if we look at the cycles of the market, we see kind of flat going up, flat going up, flat going up. So there are cycles in the market, and we're going to talk about it in the next chart in a second. But what we see that most of the appreciation happens in Q1 and Q2, and then kind of the market starts a little bit to be flat. Obviously, there are some cases where we talk a little bit about it later, and what happened here, for instance, and we're going to touch it a little bit later on. So if we look here at the inventory versus sales, okay, so red is inventory, red is sell, and blue is inventory. So obviously, whenever you have here 5 homes for every buyer, and here you have 7 homes for every buyer, the market shifts. And so a few things that I want you to look at. Number one, again, cycles in the market, which we see much better here, okay? Typically, the low point is the December, January, high point is the July, August, and vice versa, and it keeps repeating itself. This is the dot-com crisis, where Silicon Valley lost 250 jobs, okay? And this is the financial crisis, when obviously there was this meltdown here in the industry. And what we see here, that this, as I mentioned earlier, that the low point is obviously December, January all the time. And we see this is being the crisis, the economic crisis, these two. And this is sort of the normal market, okay, flat market. And we have the cycles of the market, which is a seasonal cycles of the market. And where we are today is here, we are today. And what we're gonna make it a little bit bigger, what we see here, in a sense, we do have here supposedly more sell than we have inventory. How is that possible? It is possible because MLS is tracking the sales on MLS, while the inventory on MLS, while sales are being tracked on in the county in general. And it's also there are few sales which are off market, off MLS. So that is explaining how we have more sales than inventory, which obviously otherwise cannot make sense. So that's something to remember. Remember is that there are cycles in the market, and there are price appreciation mostly happening in the Q1, Q2 in general. There are COVID has introduced a little bit anomaly into the market, the long-term trends, but nevertheless, though, these are sort of the long trends of the market. If we look here at the prices in, for instance, Palo Alto for the last year or so, so between the average and median, we see some average is obviously always higher than median. If this is Sunnyvale, a little bit more, the delta is not as substantial as home prices, because obviously in Palo Alto, you might have home prices in $10 million plus, and the lowest probably is about $2 million, $3 million bucks. And in Sunnyvale, you don't have such a big discrepancy. If we look at the buyer market versus sellers market, what we see here that we've been in the seller market since for very, very long time, okay? And since 2000, and it dropped already here. The Silicon Valley real estate market has changed in the summer of 2010. We've seen that dropping all the way and staying there for ever since, over almost 10 years, 12 years. We're in the seller market where we've seen a substantial price appreciation. And when we look at the sales price versus list price, we see very much prices are going over sometimes 13 and 15%. One thing to remember is that as far as how this thing is being priced, because many times the homes are not necessarily priced at fair market value. And what we're seeing is that unfortunately it became a sort of a norm that agents are underpricing their homes below fair market value. And they do that by creating some frenzy and competition and so on. It's very unfortunate, but nevertheless, that this is the kind of trend. Some areas are pricing it, underpricing by 5%. Other areas are pricing it by 10 to 15. It also depends on some realtors are a little bit more aggressive than others. We have seen in Sunnyvale recently homes selling close to 1 million over asking. Some of that is obviously underpricing the home below fair market value. And some of that is literally an incredible competition, very low inventory, and people with a lot of money that are falling in love with the property or sick and tired of making offers which are being rejected. So we see that happening many times. As part of affordability, affordability is very important. Affordability is basically the ratio between the median income to the median housing price given the cost of capital. And what we see, I'm tracking that information for 20 years. And what we see, this is for San Mateo County, is the light blue, and the purple is Santa Clara County. And what we see here, this is basically the financial crisis, the Q3, where prices affordability reached 8% in San Mateo and 11% in Santa Clara County, which, just to think about it, is that only 8% of the population of Santa Clara or San Mateo County were able to afford buying the median home, which means that even people who own their home, if they would be in the market, could not afford buying that home today. Okay, and obviously that was the crash of the market 2009. It was the .com, and that was the crash of the market, where we've seen very high affordability relative in Silicon Valley 44 and 32 compared to the United States, where we see that the United States was 64. The affordability at best in Silicon Valley was 44 in Santa Clara County and 32 in San Mateo. Where we are today roughly at, and that is up to Q4 21. So we have not seen yet the increase of interest rate impact on the current affordability. We're definitely going to see it. It's updated on a quarterly basis. So next time, in about probably in the next presentation, we're going to see an impact of that interest rate increase on the affordability in Silicon Valley. We did see some dropping here in the affordability and an increase in the affordability, and that was some interest correction. We see, look at this number here in 2018, where we see some increase in the affordability, and that was because, and I'll show you that chart in a second, what was the impact of that. So here is a chart of 30-year mortgage rate. Okay, so this is 2018. If you remember back in Q4 2019, the Fed start increasing their rate of interest rate. Stock market crashed by 20%, and also home prices crashed basically, which brought to this affordability increase here. You see the increase in affordability in 2018. That was as a result of basically what happened here. The Feds, after increasing the interest rate for Q4 of 2009, lowering this interest rate from December of 2018 to this point here, and obviously drop it to about, I refinanced my home last year to a 2.65 interest rate, okay? Obviously where we are today at about 4.5% roughly, and that's in general, but obviously your circumstances, you might get into about 4.25, depends on what kind of loan, the credit history, down payment, and so on and so forth. So this is where we are today. So obviously affordability is the impact. And I mentioned before, what are the impact of affordability? So we talked about the migration, okay? So look at this, what's the impact of population changes in Silicon Valley? So we have a net foreign migration, domestic and net, okay? So this is the .com crash, where we saw about 250,000 people living in Silicon Valley, okay? At the same time, you saw that we had a very strong immigration, foreign immigration, very strong here. But we saw a lot of people live in Silicon Valley here. Then we see the financial crisis. Again, we saw quite a loss of population, but again, we had a substantial foreign immigration, and typically the foreign immigration in Silicon Valley is most likely, most typically high-tech young professionals. And here is the high-tech boom, which started basically in 2010. We see a major continuation of foreign immigration. Almost no, we see here actually a positive migration from the United States, okay? almost no migration out of the United States. And here is the pandemic, obviously, and that's basically, pandemic started here, and obviously here when Silicon Valley home prices start becoming very expensive, we see a continuation of domestic migration, okay? And also we see here the impact of a slowing down of immigration, which was mostly an impact from the Trump administration policy about SB 5 and so on and so forth, about visas for foreign-born engineer. Obviously, we see a substantial drop in migration here, domestic migration from California, and also a slowdown in foreign migration because pandemic and mostly, and the slowdown in the from other reasons that was impacted from this Trump policies. If we look at the number of jobs, the percentage of change, okay. So what we see that Santa Clara County added 5.3 jobs, okay. And what we see here, total number of job percentage change. Okay, again, the dot-com crash, we saw a major loss here, the financial crisis loss, and this is the high-tech boom, which again started in 2010. And this is the pandemic impact. And look at that, immediately a year later, we see a major job growth in Silicon Valley. Okay, if we look at the employment growth, we definitely see that there is a growth, employment growth, largest Silicon Valley tech companies. So we see a major growth in the San Francisco Bay Area, okay? We look at, in terms of, we see that we have here a percent growth versus absolute growth. So yeah, we see Atlanta and Austin, the percentage-wise, you see large numbers, but if you look at absolute number, you can clearly see that the Bay Area is still growing faster than all other areas, high-tech hubs across the United States. So for instance, Austin, Texas, the kind of population growth versus 25,000, so 5 times more. Yes, it might be a trend or whatever, but again, the point is, as long as the high-tech industry is growing in general, it's okay for other areas to grow as well. And again, yes, we do need to do some change in policies and so on to make it more attractive and more livable in Silicon Valley as well. So employment level relative to pre-pandemic area. So we see that information technology, if we look at the industries, okay, well, we see clearly all industries kind of dropping, but the innovation technology industry is growing, okay? So clearly we see here a very clear trend of the impact of technology and how critical it is to the future growth of the economy in general, and obviously Silicon Valley. And if we look at who is leaving and who is coming, the domestic migration, so we see renters are coming in and owners are moving out, which hopefully gives you more inventory. We look at the domestic by income, we see people who are with lower income level compared to higher income level coming in. So salaries below $100,000 moving out, salaries over $100,000 moving in. If we look at the domestic migration by education, less educated moving out, educated moving in. If we're looking by age group, young people are moving in and older people are moving out. So when you look at all that data, take that into consideration and make sure you double click on those headlines to have a better understanding what's going on in this area. Okay, good. Another segment, I open it up for Q&A again. So I see there is some chat question. Let's see if there is. Where can I buy a home for 1.3 range? Okay, question, where can you buy a home in 1.3 range? You can buy it in probably area like South San Jose, East San Jose, Gilroy area, and so on. Some areas of maybe a little bit north, Redwood City, and so on. And definitely, maybe you can buy a townhome, condominium, and those kind of price point. What is the difference between absolute employment growth and employment growth? Well, absolute employment, I'm not sure I know the answer to that, but I think what we'll, I'm not sure I know the answer to that question. Sorry about that. And one other question in case you have, okay. What about who buying a second home? Okay, there is a question about a second home. We see people buying second home, not so much here in the Valley, but we see, if you look across the United States, we see a major, I would say about 30% of people buying homes across the United States are investors and people who buy second homes. Silicon Valley, because the homes are relatively expensive, you do not see so many people buying second homes, but of course there are some people who do. Myself, my wife and I, and my son, we own a second home in East Menlo Park, which is an investment property, which we bought and fixed and currently renting. So we do have a second home in Silicon Valley, but you don't see that a lot of people who do have a second home here. If they do, it's typically more maybe in Lake Tahoe area or vacation area than actually local here in Silicon Valley. There are some people who are buying homes for their children, but this is not a very typical thing. And the second home is more typical to investors who are buying outside of Silicon Valley. Any other questions that people would like to ask before we move into the next segment? Okay, I'll move on to the next segment. So what is the post? I see there's one question in chat here. How about places like Tracy and Mountain Housing? It's also growing a lot. There is the question about Tracy. There are many places we have seen a major appreciation, both in California and outside of California. So I don't know much about Tracy, but I'm sure there are places. We typically invest in 8 different locations. We invest in California, some places, not all of them, and mostly in the Sacramento area, Silicon Valley area. We do invest in Las Vegas, Arizona, New Mexico, Tennessee, Atlanta, and other places. And we're looking to other areas to continue to invest. But that's what we are looking at. Okay, the post-COVID-19 economy. And that's transitioning to the new normal, okay? Santa Clara and San Mateo have a vaccination rate above national average, which is very good information. Optimism that tweaking the current vaccine will be effective against virus mutation. Obviously, we as a community have to make sure that as much as, I know there is a lot of opinion about this matter. There's no question about it. A lot of people don't believe in the value of vaccination, but the fact is that we have doing relatively well is a proof that it does work. Yes, there are some long-term effects that we don't know yet, but as of now, it looks like we have made the right decision. And then a very important thing is that people and industries and government start realizing that the post-COVID new normal is a world that, as we have learned to live with HIV and the flu and other pandemics, hopefully we'll learn how to live with that and be able to resume as much as normal life as possible. Technology is what we have basically learned. That technology is essential enabler for the post-pandemic world economy. This is something which was demonstrated so clearly and without question that is benefiting us, obviously. Silicon Valley companies' economy were among the first to recover and the one most to benefit from the post-pandemic world. No question about it. We see the wealth, the creation here, how well those high-tech companies are doing. That is definitely proof that this is the industry that is leading the new economy. As long as Silicon Valley it continued to lead the innovation for this normal, it will grow and prosper. As we indicate, there will other places. Remember, the image that we have to keep in mind is Detroit. Detroit used to be the center of innovation back then. if we're going to fall asleep, that would what happened to Detroit going to happen to Silicon Valley. So we have to be very, very careful about it and continue working on staying at the cutting edge. For high-tech workers, the new normal would be probably hybrid model. I hear that companies are starting to go back to the offices, Google, Apple, and many other are, and it's obviously going to be some sort of a hybrid model. We hear some grumbling of some employees about it, but we'll see how the new normal. And one indicator, which is very significant, is the simple fact that the major companies are buying commercial real estate left and right, and anyone who tracks this information can see that happening. The H-1B visa policies, which are very important as new administration, continue bringing those creative, smart people from all over the world to Silicon Valley and in the United States in general. That is a very important component of our future growth. The local commercial real estate market to be impacted. We see that. And obviously, with all this great news, we do have challenges, obviously, and the politician have to address those. We don't see too many companies moving their headquarters away from Silicon Valley, and hopefully, and I believe that this topic is being addressed and rather than being dismissed. Silicon Valley real estate isn't a single market, okay? We have multiple markets in Silicon Valley, 3 board market segments, okay? We see the up to $1 million, and because we cannot look at the Silicon Valley as a homogeneous market. There are different segments in this market, and we cannot treat them as alike. So we see the low-end market up to $1 million, okay? And we see the U.S. Just as by the way, at 330. This is a tier 1, 2, 3 workforce, which mostly in the service economy and so on, which is much more sensitive. In any past the contraction of the Silicon Valley economy, this is the segment of the market that always was hit the hardest and took the most time to recover. And the mid-range market, somewhere probably between the Santa Clara and the Sunnyvale market, few homes maybe in Palo Alto, but mostly that's the mid-range of the market. These are the tier 1 workforce. Mostly it's a professional economy, and this is a type of economy which is hit less, at least from the Silicon Valley economy. This is typically the core of the workforce in Silicon Valley. And the high end of the market, which obviously is changing. We've seen some segment neighborhood in Sunnyvale these days that are reaching $4 million. So we have seen this kind of market shifting, particularly in the last half a year or so, half a year to a year, major appreciation happening in the Sunnyvale area, where we have crossed $3.5 and even $4 million already. A discretionary purchase segment and is softer, but again, this market is kind of moving a little bit. We see many people who work in the high-tech business, which we have a lot of money, very high income, and have cashed a lot of stock option RSUs that enable them to be in those kind of price point in the higher end of the market. And obviously the fact that we have a very limited inventory does not make things any easier. Okay, with that, we are kind of done with that part of the real estate market. We'll talk now about the Urban Group and what is our added value, what we can bring to the party. So we like to categorize it in 4 groups. So in knowledge, okay, skills and experiences, service, and extended team. And basically, these are kind of anyone who is looking to establish connection with a realtor should make sure that any realtor or any group or realtor that they choose to work with, make sure that they can address and bring that kind of value to you, whether you're going to decide to work with us or any other one. So obviously there is a lot of knowledge component to that, okay? And that is basically you have to understand about the real estate, the economy, the neighborhood, real estate contract disclosure, taxes, and construction. I've been in high tech for almost 25 years. And as someone who was in the high tech, I would tell you that real estate, being a realtor is a very difficult profession because there are so many modalities that you have to have knowledge about. Okay, and basically, unlike when you're an engineer, most typically kind of focus, you don't have to deal with marketing, business issue, people issue, contract issue, and so on. So it's a very complex industry, profession. And definitely, you have to be very careful before you make a selection of who are the people you're going to work with. In terms of people and people skills, negotiation, marketing, business organization, industry, all those factors are going to impact how successful you will be and whether you're going to, what kind of experience you're going to have. Obviously, this is an industry you want to make sure that, that you're working with very ethical people, that are responsive, objective and factual, thinking mostly about your interest. They provide you ongoing feedback, have an reputation, and so on. You have to remember that this industry here in Silicon Valley is quite a close-knit in most of the area. Realtors have reputation, and you basically have to inquire about their reputation via Yelp, LinkedIn, and others, and referral from people you work directly with, and make sure that you make the right choices. Extended team, these are basically lenders, appraiser, contractors, and so on. As when we are working with our clients, we are basically a turnkey service. We help them. Typically, our clients are, most of them, I would say 99% of them in the high-tech industry. They are very busy with work, family, and life, and they are looking for someone who can have a turnkey solution for all their needs, understand having all those skills, and so on. So most of you think that the role of a realtor is basically to find you a home, which is the tip of the iceberg. But the real hard work is not something which is obvious to everyone who particularly did not go through this process at all. So what is our mission as our realtor? Find you and your family the right home, short and mid-term, number one. Right cost versus price, because cost is what is the purchase price, plus the closing expense, plus what does it take to make the house move-in ready, short-term and long-term, versus the price, which is just the listed price. Right timing, is that the right time from a personal situation, economy, real estate, and market, so on. I did actually, given the kind of incredible high cost of home now in Silicon Valley and the rising interest rate, I have few clients who are, between the 2.5 to 3.5 million price point, they're looking to buy homes, and they're basically stopping or holding because they are confused of the situation. They're not sure how far it can go. They're basically, the areas that they want to buy have basically become out of reach for them, and some believe that the market might correct with the fact that interest is going up. It's possible, it happened in the past. The correction that we have seen in the past, unless it was a meltdown of 2001 and 2007, probably can be in the 5 to 20% at most, but I have not seen a price correction due to interest rate, and obviously it depends where the interest rate going to go over those kind of numbers. Without hassle and problems before, during, now, okay. One thing that you want to make sure that the person who you're going to be working with knows exactly what's happening, and you will not end up in a litigation or discovery of issues after the close of escrow. And you want to make sure that you're working with people who have been in the process a few times and have a steady hand and have seen this industry over many years. Superior service through the entire ownership. As I mentioned, we are viewing ourselves as holistic realtors. We do not see as that our relationship ends at the time when you are closing the transaction. We are here to support you through the entire ownership with your current home, future investment, expansion, and any issues relating to real estate that we can help. We'll be happy to do that. Also help you establish your long-term real estate investment portfolio. I strongly encourage you to register and participate in our introduction to real estate investment. My wife and I have made many investments in real estate. And as we are reaching our retirement age, we are very comfortable financially because we have established a very deep portfolio of passive income that will allow us to live very comfortably in our relationship. Obviously, hopefully the world going to continue to be a sane place, and what's going on in the world right now is a little bit scary, and hopefully it will contain and not become a major issue across the world. Become your lifelong everything real estate advisor. This is our objective. Our guarantee for a buyer satisfaction guarantee we have for anyone who worked with us. We have not ever had this case happen to us, and because we try to be very careful, we hope we would not be in this in such a position in the future. But so far, 17 years of many transactions, we have not been we've not been asked to sell a property which people felt that they were not happy with. Seller satisfaction guarantee, we do have some also that. We currently have now 2 listings, one in Palo Alto and one in Sunnyvale, which are going to come in the market shortly. We do provide a lot of benefit to our clients. We pay for our staging, for inspection. We take full control of the project management, and we have many happy clients. And I would encourage you to check our credentials online, Yelp and LinkedIn. Our recommendation. So this is, I think, one of before the last slide. So with all those talk about Silicon Valley economy, real estate market, and so on. So what is our recommendation? The AGM, buy your Silicon Valley home if the IGM ETF is on an upward trend or hit bottom, okay? So we want to make sure, and that is why do I look there, as I mentioned a few times, Silicon Valley real estate is a derivative of the local economy. The Silicon Valley economy leading indicator is how the stock price is performance, because the stock market is a discount mechanism for those companies' performance. So look at those chart to be making sure that those companies continue to do well. Your 6 to 18 months point of view of the local economy is relatively positive, very important. You are relatively confident with your job security, okay? Silicon Valley is your home for at least the next 3 years, okay? Because if for whatever reason the economy changes, it's typically the down cycles are short-lived, between 1 to 2 years. And since you don't, probably nobody wants to lose money, so it will give you enough time if you must leave and sell to recover your expenses. You prioritize your needs and wishes with your kins and lifestyle. Very important to make sure that you and your partner are on the same page. Make sure what is a must-have versus a nice-to-have. What can you afford? I do not believe in becoming a slave to your own home. So make sure that you and your partner are doing your homework and making sure you're defining clearly what is your nice-to-have versus must-have. Okay. You have down payment and reserve. As Arash mentioned, reserve are very important. Reserve gives you the buffer if, God forbid, something happens, and you would not have to do a fire sale or whatever. You can make a monthly payment without being able to maintain a quality of life. Okay, as I mentioned, I don't believe in anyone should become a slave to the home. You should continue living life, enjoy family, go on vacation. And obviously it's always a balancing act between living the moment and living the future. So whatever is right for you guys, this is what you should be doing. But if you can't afford buying your perfect home, buy the home you can afford, occupy or rent. So there are, for instance, one client that I'm working with right now, they want to live in Sunnyvale, but there's some area of Sunnyvale which are a little bit out of reach for them. So since their daughter is in the last year in high school, so they are now considering buying a home, not in the ideal place they want, but in a secondary nice place, which is less expensive and obviously less punishing from a payment perspective. And this way, they're going to rent it first for about a year or 2 years and then move to it and being able to enjoy the future once the schools are no longer critical for their children. Whatever you decide to buy or rent, each decision has associated risk, okay? And that's something you should be aware of. So the big question is, do you believe the market will correct more than the cost of rents for the next 3 to 5 years, okay? And if you see that this happening, then you maybe should stay as a renter. If you're not sure about it or you don't know, then it's basically a question of a gut feeling and whatever you're comfortable with. You identify a real estate team that you can trust. That's very important. This is what's going to make or break your experience working on purchasing your home. You believe in a better tomorrow. That's basically, I'm an optimist by nature and believe that on the long term, things are going to work out. Obviously, we have to work at it. It doesn't happen for itself, but in general, I do believe in a better future and in a better tomorrow. Okay, buying or selling a home in Silicon Valley is really finding your way through a maze. It is a roller coaster. I would tell you, my colleague here have wrote already 6 offers with one client of theirs. It's a roller coaster. It's frustrating. It is discouraging. And anyone who thinks about getting into this should be aware that it's not a trivial experience. And because of that, you should be working with very experienced team that's going to help you and keep you, guiding you through the process. Next step, schedule a personal follow-up meeting to discuss your wants, needs, and cans, okay? Get pre-approval with a reputable lender. Obviously, we can help you, make your few recommendations based on your particular situation. Agree to an exclusive agreement. We only work with people who are committed to work with us, and the reason is very simple. The process, as I mentioned a few minutes ago, a colleague of mine just wrote 6 offers or 5 or 6 offers with one client, and because of that, we only get compensated when there is a closed transaction. We do expect a kind of arrangement or relationship which is based on trust. Obviously, if we don't meet your expectation, you always can fire us. But give us a chance if we have missed something, that give us a feedback and we'll try to correct. It never happened to us yet, but nevertheless, though, we are obviously very open about that. Start searching for your dream home. And this is a process that we work as once we get the pre-approval, once we get your profile, understand what you're looking for, then we're working with you to finding your home. And that's how we work. And we're going to send people who have participated recording if you want to take a look at that. And we want to thank you for participating in the presentation. Thank you very much. And I will open it up for the last segment of the Q&A.